Hey everybody, welcome to just a little review talk through for the comprehensive final exam. So the exam is going to be 70 questions and it's going to be 3.5 hours. It's going to have roughly 15 questions from chapter 12, and then it's going to have about 5 questions each from chapters 1 through 11. Anyway, and so several people have asked me to do this where I just kind of talk through the review guide. You can always find this review guide. Before each exam, there's an exam review. If you click on it, it has this same PDF, which is broken down by exam. So I'm going to actually start with chapter 12, since that's the bulk of it. That's 15 out of the 70 questions, and it's the newest information. So the first bullet point is to know what items are generally used in preparing the statement of cash flows. So what that means is we need to be able to use our income statement and our balance sheet as we prepare our statement of cash flows. In the operating section, of course, we're going to use the net income from the income statement, and then we're going to subtract out any depreciation expense, and then any other expenses, specialized, say gains or loss on sale of things like that, to do our operating section. And then we'll adjust for changes in current assets and in current liabilities. That's what we would do for the operating section. And then we would use the rest of the income statement and the balance sheet, and sometimes any notes we might need for the rest of the statement of cash flows. The second bullet point is to be able to identify what kinds of transaction events would be reported in the operating section, and then they have the third bullet point is in the investing, and then the fourth is in the financing. So I'm just going to pull up the textbook right here. It has a really good review on page 593, where it breaks down the operating activities. So there's the cash inflows from sale of goods, from interest received, and cash outflows to pay suppliers for inventory, employees for wages, government for taxes, lenders for interest, and other expenses. So those are the normal things you'll see in the operating section. Then the investing activities section, it's typically things that have to do with our large fixed assets, things like sale of property, sale of investments, things like that. Could be sale of equipment, or if we collect principal on loans that we've loaned to other people. Those are all considered inflows from investing activity, and outflows would be the purchase of those, or making loans, or purchasing investments. Finally, the financing activities section would involve any cash inflows from the issuance or sale of our common stock, or from issuing bonds, or outflows related to the same things, including paying dividends. We consider that part of the cash outflows from financing activities. And then the next bullet point, which I'll go back to in a minute, was what item. Well, let's just look at it. I think it said be able to identify what kinds of transactions or events that would be reported in the footnotes or in a separate schedule after the body of the statement of cash flows. And that would be these significant non-cash activities. So if we issue common stock to purchase an asset rather than for cash, that would be a non-cash activity, but we'd still report it in the footnotes. Conversion of bonds into common stock, etc. You can read the list. I don't have to read it to you. All right. Know which section of the cash flow statement best measures the company's ability to continue as a going concern. And what that really means is, if you look at the different sections of the cash flow statement, it's the operating section that tells us if we are making money or losing money from the day-to-day business that we do, right? If we look in investing or financing sections, those are more extraordinary items. We don't borrow money every day. We don't purchase buildings or equipment every day, or sell buildings and equipment. Day to day, we sell our product or service to people, and then we collect the money. And so it's that operating section that says, if we're losing money there, then it means we have to borrow money or issue stock, or sell off our other assets to stay in business. Whereas if we're making money in the operating section, then theoretically we could not make or pay out any money from the other two sections, and we could still operate. So the short answer is it's the operating section. All right. So these next three are just, we have to be able to use data in a comprehensive problem to calculate the net cash provided or used by operating activities, investing activities, and financing activities. In other words, you have to be able to create a statement of cash flows from the appropriate information. That's all. I don't know what else to say about that other than make sure you can do that. And then finally, be able to calculate free cash flow. So let me turn to a page in our textbook where that might help. All right, here we go. Is page 609 in the book is free cash flow. And really all you need to do is know the formula here, which is our net cash provided by operating activities minus capital expenditures minus cash dividends. Recognize that capital expenditures just means money spent on large assets like land or buildings. So if you know that formula, you should be able to do that. So that is free cash flow. All right, so let's jump into now the rest of this final exam. So again, it's going to be comprehensive, meaning there'll be questions from every chapter that we've covered. Don't panic about this, okay? You remember more than you think you do. So if you just go through this list and sort of review these items, remember I've said in the past that whoever wrote these reviews, and it wasn't me, but whoever wrote them was looking at the test while they did it. So, it should be pretty doable. So I'm going to pause this video a second while I turn to chapter 1 in the textbook so we can look at a couple of these items. All right, so chapter 1, the first question is be able to identify who the users of accounting information are. So this is where I just want to turn to the book and show you that the book breaks them down by internal users. So those users of the financial information that are internal to the company. That would include people like the finance directors. They need to know if we have enough money to pay our dividends. The marketing people, they want to be able to use that information to set prices and all sorts of things. And human resources, can we give a raise this year, et cetera. Management, which product is a good product, and so forth. So those are the internal users, pretty much the managers of the different parts of the company. And then on the next page, they have external users. These would be people like investors, people who are thinking of investing in a company would want to look at the financial information of the company. And creditors, people who are thinking of lending money to the company. You want to know if they have the ability to pay. The government or taxing authorities, labor unions, regulatory agencies, these are all potential external users of a company's financial information. All right, know the basic accounting equation. So you know that is assets equal liabilities plus equity. And then you might need to understand the expanded version of that, where the equity section actually has revenue minus expenses and minus dividends. And I'm trying to think so equity is our revenue minus expenses, which is our net income, and then our minus any dividends and our retained earnings, right? That's the equity section. So assets equal liabilities plus equity, where equity equals revenue minus expenses minus any dividends, and I forgot common stock, and then retained earnings. So it's listed right there. Anyway, under the next one, which is know the basic definitions and examples of assets, liabilities, stockholders' equity, revenue, expenses, dividends, common stock, retained earnings. So we know assets are things that the company owns, and liabilities is money that the company owes to others. And then stockholders' equity is the difference between those two, which really means the amount of the company's assets after we subtract out liabilities that belongs to the shareholders or the stockholders. Stockholders' equity is made up of really our common stock, that's money contributed by the stockholders, and our retained earnings. And then our retained earnings is made up of our net income, revenue minus expenses, less any dividends that we pay out. So that's the basic definitions. Know the basic financial statements and their components. So the income statement, which shows revenue and expenses. and then net income. Revenue minus expenses is net income. And then the balance sheet, the statement of retained earnings, which shows our beginning retained earnings, plus any net income minus any dividends gives us our ending retained earnings. And then our balance sheet, which has our assets, our liabilities, and our equity. And then finally, the statement of cash flows, which you should be very familiar with because it was all part of Chapter 12, which just has exactly what it sounds like, the cash that's come into the company and gone out of the company in all three of those sections we reviewed already. Recognize the interrelationship between them, which is the net income flows to the statement of retained earnings, and then we use it to calculate the ending retained earnings, and the ending retained earnings flows to the balance sheet, which is in the stockholders' equity section. And then know how to compute net income, retained earnings, and total stockholders' equity. So again, net income is revenue minus expenses. Retained earnings is the previous period's retained earnings plus any net income minus any dividends, to give us the new period's retained earnings. And then total stockholders' equity is going to be our assets minus our liabilities will be our total stockholders' equity. Or another way to look at it would be to say our capital or common stock, just our stock, both common and preferred, plus our retained earnings is going to be our stockholders' equity. All right, so there's chapter 1. Let's move on to chapter 2. All right, so I took a moment to find the pages for chapter 2 in the book to show you a couple things. So the first bullet point under chapter 2 is to know the 4 asset categories and the 2 liability categories of classified balance sheet. So I just wanted to show you in the book. And it says, and be able to distinguish between long-term and short-term assets and liabilities, be able to classify the different accounts into these categories. So here's the 4 assets that they show in the classified balance sheet. Current assets, those are assets that are that are either cash or that are readily convertible into cash within the next year. And then long-term investments, property, plant, and equipment, things like buildings and land and equipment. And then intangible assets, those might be things like I'm drawing a blank, but things like copyrights and patents and so forth. And then our liabilities, our current liabilities, or liabilities that are going to come due within the next year, and long-term liabilities, or liabilities that will be due more than a year out. The second one here is know the order of the balance sheet accounts. This thing is actually listed in that order. So current assets, then long-term investments, property, plant, and equipment, intangibles, current liabilities, long-term liabilities, and then stockholders' equity. So that's the order that they come in the balance sheet. Let's see. Know what things affect a company's retained earnings. I mentioned this in the chapter 1 review. Remember that retained earnings we find by taking the previous period's retained earnings, we add any net income. And remember, net income is revenue minus expenses, or we would take away a net loss if our expenses were greater than our revenue. And then we would subtract dividends, and that would give us our new retained earnings. So it's really revenue, expenses, and dividends that impact our retained earnings. All right. All right, know what generally accepted accounting principles are, so GAAP. Those are just the accounting rules or principles that guide how we do accounting in the United States. We follow GAAP. That is as opposed to IFRS, International Financial Reporting Standards, which is what they follow in much of the rest of the world. There's not a huge difference between GAAP and IFRS, but there's some for sure. All right, so know what materiality is, including examples. So materiality means as if we're dealing with numbers, is the number material? So what I mean by that is sometimes you'll see the financial statements of a large company might say in billions or in millions, meaning to them, being off by $100 on something isn't material because of the massive size of the company. My little company that only does $20,000 a year in revenue, then I track everything down to the dollar, right? But even then, I don't do it to the penny. When I do my taxes or things, they always have you round off to the nearest dollar. So materiality is just to what level we need to take the accounting information, given number one, the size of our company, and number two, the nature of the reporting we're making. In some reporting, we need to be very exact, and others, being very exact would not be material. And then finally, know the following: economic entity assumption, going concern assumption, monetary unit assumption, periodicity assumption, full disclosure principle, blah, 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 blah. So all those terms, I would tell you just to look in the chapter. I don't think we need to spend a lot of time. Those are just terms you can look up there in chapter 2. To make it easy, I just looked it up in the book. So here on page 61, it has them broken down for you: monetary unit assumption, and so forth. So hopefully you can just check those out. In fact, I'll even scroll through them slowly here. So if you need to, you can just look right here instead of looking them up in the book. Anyway, so there we go. So that's the chapter 2 items. So on to the chapter 3 items. Know how to record events in terms of changes to the basic accounting equation. Remember, the basic accounting equation is assets equal liabilities plus stockholders' equity. So if it gives you an example of a transaction, you should be able to say the assets increase and the stockholders' equity increase, or the assets increase and the liabilities increase, etc. So be able to record events in that way, and then be able to journalize various transactions. So we haven't ever really stopped doing that in this course. Just remember, debits on the left, credits on the right, and then remember those rules, right? That a debit or that different accounts are impacted differently. So assets are increased by debits and decreased by credits. Liabilities and equity are the opposite of that. And then we know revenue and expense. So expense is increased with a debit, decreased with a credit, and revenue is the opposite. Which is the third one, which is know the rules of debits and credits and the rules of normal balances. Remember that the normal balance is the side that increases the account. Know what double entry accounting is. Double entry accounting is just that there is always at least 2 entries, a debit and a credit. And even if there's more than 2 entries, the debits and the credits have to equal each other. Know the steps in the transaction recording process. So I'm actually going to show you this in the book because this, each book has, I guess, a specific way they want you to look at it. So I'm going to pause the video for a second while I turn to that page in the book. Okay, so here it is in the book. So the steps they're talking about are right here to analyze the transaction. In other words, understand what's happening and to which accounts. And then we enter the transaction in the journal, or sometimes they call that journalizing the transaction, where we debit one account and credit another account. And then finally, we transfer those items from the journal to the ledger, where we keep we keep it by account. So remember that a journal is this chronological listing of all of the transactions that occur, and then the ledger is listed by account so that we can see the balance of each account as we go along. All right. So know what a chart of accounts is and the order that accounts would appear in the chart of accounts. We know that a chart of accounts always lists things in, I call it statement order. So it starts with the balance sheet items or accounts, which are assets, then liabilities, then dividends, then stockholders' equity. And then it moves on to the income statement accounts, revenue, and expenses. So just recognize that it's always in that order. We could probably come back here if we wanted to, and I could show you a picture of it. Let's see where it shows chart of accounts. Maybe I can't find it that easy. Let's see. So here's their chart of accounts. So again, they have assets, then liabilities, then equity, then income, then revenues, then expenses, like I just said. Let's see. Know what the general ledger is. So again, the general ledger, when we talk about that, we're talking about, sorry, I should pause it while I find this. Here, I'll pause it for you and then I'll come back to it. All right, here's our general ledger. So by definition, it has all of the asset, liability, and stockholder equity, revenue, and expense accounts listed. So there's the general ledger. I don't know why they show it this way. Usually it's just on a piece of paper and it's a list. Anyway, so that's the general ledger. And then it says, know how to prepare a trial balance. Remember I said that we journalize or put things in the journal and then we post those to the ledger or the T accounts where we see a balance for each account. Then we take those balances for each account and we post those to a trial balance. So the trial balance is just a listing of all of the accounts that have a balance so that we can see that all together. So, and it always has them listed as either debits or credits, whatever their balance is. And then we know they have to balance at the end. So that's a trial balance. Make sure you know how to make one. And that is it for chapter 3. All right, so in chapter 4, we have the revenue recognition and expense recognition principles and how to apply them. So all the revenue recognition principle is it means that we should record revenue during the period in which we earn the revenue, which means we either do the service that we are doing for the revenue or we provide the goods that we are selling for revenue. That's when we should record them, regardless of when we receive payment. And then the expense recognition principle, sometimes called the matching rule, that just says that we should we should match our expenses to our revenues. So if we have an expense that's related to earning the revenue, then we should record it in that during that period. That's why, for example, things like depreciation involve us spreading out the recognition of the expense for an asset over its useful life, because the idea is that the asset is going to earn revenue for us. That's the point of getting assets. And so if it's going to earn revenue for us for the next 20 years, then we should be recording the expense spread out over the next 20 years, not taking the expense all in one period. So number 2 is understand the difference between the accrual basis of accounting and the cash basis of accounting, and know how to calculate net income under both. So recognize that under accrual-based accounting, like I just said, our revenues will be recognized in the periods that we earn the revenue, and our expenses will be recognized in the periods when we incur the expense. That's the accrual basis of accounting. It has nothing to do with when we get paid for our work, because sometimes we get paid in advance, sometimes we get paid later, or when we get paid for the goods we sell, and it has nothing to do with when we pay for an expense. Sometimes we pay for an expense before we incur that expense, and other times we pay for it after. So accrual means we record it when we earn it or when we incur it and then the cash basis is just the opposite of that. The cash basis means we record revenue when we get the money, regardless of when we earned it. And we record expenses when we pay money, regardless of when we incurred the expense. So be able to calculate net income under both, or even to compare the two, right? If you think of previous exams. Know what kind of account accumulated depreciation is. So accumulated depreciation is a contra asset account, and it's always linked with a specific asset account. So it might be like equipment, and then there will be a linked accumulated depreciation on equipment account. Let's see. Know which accounts normally would be adjusted. So the easiest way to do that is I'm going to pause the recording for just a second and open up the textbook and show you the different types of adjusting accounts, which will actually handle several of these bullet points. So I'm just going to pause it here for a second. All right, so again, knowing about adjusting entries and the types of accounts that they involve, and what would normally be adjusted. So there's really 4 types of adjusting entries. Like I said, this will handle a couple of the different bullet points here for chapter 4. There's deferrals and accruals, so 2 categories, and then 2 types of adjusting entries in each one. The first is what's called a prepaid expense. This is where we pay for something ahead of time, and then our adjusting entry is to record the expense when we incur it. So the adjusting entry is always going to involve a debit to an expense, so that's the recognition of the incurring of an expense, and then a credit to an asset. That asset might be something like prepaid insurance, or prepaid whatever. Okay, prepaid rent is another common one. So the adjustment for prepaid expenses is always a debit to an expense and a credit to an asset account. Okay. Then there's unearned revenues. This is where we received cash before the services are performed. And remember, when we do that, we create a liability account called unearned revenue. And then our adjustment is always going to involve a debit to the unearned revenue, so a reduction of that liability, unearned revenue, and a credit to the revenue account, because now we're recording that we've earned that revenue. That's what the adjustment is. Then the accruals, there's accrued revenues. This is where we have already performed and already earned the revenue, but we haven't yet received payment. So the adjustment is just going to be to record that we've earned that revenue and increase an asset, usually like an accounts receivable. It would be our debit, and then our credit will be the revenue account. And then finally, accrued expenses. That's where we've incurred the expense already, but we've not yet paid it. So our adjustment will be to recognize that. So we'll debit expense and credit some kind of liability, like salaries payable or something like that. So those are the 4 types of adjusting entries and the types of accounts that get used in those adjusting entries. So let's go back. So know which accounts normally would be adjusted is what I just covered there. Know that every adjusting entry affects an income statement account and a balance sheet account. I didn't say that specifically, but again, if we say, okay, prepaid expense, that's going to be recognizing the expense. There's our income statement account, and then crediting the asset. There's our balance sheet account. Unearned revenues. Again, we're going to debit the unearned revenue account. That's a liability. That's a balance sheet account, and we're going to credit revenues, which is a income statement account. Accrued revenues. We're going to debit an asset like an account receivable. There's our balance sheet account, and credit revenues, which is an income statement account. And accrued expenses, we're going to debit our expenses, which is an income statement account, and credit our liability account, such as salaries payable or something like that. So let's see. Now, how to record any adjusting entry, including entries pertaining to accruals, deferrals of revenue or expenses, and depreciation. So I just kind of went over that, and you might want to review that again. Know the difference between permanent and temporary accounts, which accounts are closed at year end, and be able to make a proper closing entries. So remember that permanent accounts are the ones on the balance sheet. So any asset, liability, or equity account, those are permanent accounts. And temporary accounts are the income statement accounts. So revenue and expenses, and then dividends. So those are our temporary accounts. And then the last one is that the really temporary account that we create just for the closing process, called income summary. And then the closing entries are always one entry to close revenues to income summary, a second entry to close all of the expenses to income summary. Then we find the balance of income summary, then a third closing transaction to close income summary to retained earnings. And then finally, a fourth entry to close dividends to retained earnings. That's all of the closing entries. And after we do that, all the revenues and expenses and dividend accounts and income summary accounts will be returned back to zero, and we'll be ready to start a new financial period. Let's see. Be able to determine what effect there would be on the accounts if certain kinds of adjusting entries were not recorded by a company. These are tough ones because it means you have to understand the adjusting entry and then say, okay, so you have to, in essence, what you have to do if it says, if this adjusting entry didn't occur, what would be understated or overstated, right? So you have to go back, you have to figure out what that adjusting entry is and then recognize how that changes the revenue or the expenses or the assets or the liabilities. And then remember the concept that when something is overstated, it means that there is more showing there than there should be. And when something is understated, it means there's less showing there than what there should be. So I don't know what else to tell you on that other than you might want to look at the practice or the self-test because they have a few problems that pertain to that concept. Know which kinds of errors may or may not cause the trial balance totals to be unequal. Really, you just have to recognize that any error that affects one side, the debit side or the credit side, and not the other, is going to make it unequal. Whereas an error that affects both sides in the same way is going to make it equal. That's really all you can do to prepare for that, is understand your journal entries well enough to know which accounts are impacted, and then understand if they have a debit or a credit balance. Anyway, so that's what you have to prepare for that one. And then know the purpose of the post-closing trial balance and identify whether or not an account would or would not appear on it. So remember, the post-closing trial balance just shows our permanent accounts, assets, liabilities, equities, and doesn't show our temporary accounts, revenue, expenses, dividends, or income summary. So that's it for chapter 4. Let's take a look at chapter 5. So distinguish between perpetual versus periodic inventory systems. So what they're trying to do is get you to recognize that a perpetual system is one in which we are constantly updating the cost of goods sold each time we sell something and the inventory. So by perpetual, they just mean it's constantly being updated each time we make a transaction, as opposed to a periodic inventory system where we just sort of write down when we make purchases, and then at the end of a period of time, we count up the amount of stuff, the amount of inventory we have, and we use that change, right, what we had before plus any purchases, minus what we have at the end to calculate our cost of goods sold. So that's the difference between the two systems. Know the accounts used and journal entries required to acquire and sell merchandise under a perpetual and a periodic system. This includes the entries for payments and collections, returns, freight charges, and discounts. So this is a lot of information that you have to really sort out because there's kind of two things we're dealing with, right? So I'm going to pause this for a second. And I'm going to pull up a couple of pages from the textbook to see if they'll help. All right. So I think what they're trying to get at with this question is that under a perpetual system, we're going to make all of these purchase transactions to where they directly impact our merchandise inventory, right? So for example, they give here the freight costs. So we know that when we purchase something and we pay the freight costs, what we're going to do is we're going to debit those right to our inventory account anytime we do that. And then our purchase returns and allowances, again, when we return something, we're going to credit that right to the inventory account. So I think the the fundamental principle here that will help you if you're not sure when you're on one of these questions is recognizing that in a perpetual system, we make any freight in, any purchase discounts, any purchase allowances, those all get debited or credited directly to merchandise inventory. Whereas, or unlike a periodic system, where in the periodic system, we have to record all those things down um, so that we can figure out our net purchases, right? Because we use purchases as part of the calculation of our cost of goods sold under a periodic system. Whereas in a perpetual system, we record everything directly to inventory, and then we just know what our inventory is at any given time because we're buying and selling inventory. So I think that's the underlying principle that may be more helpful even than memorizing all of these different things. Recognize that under a periodic system, all purchases and things and purchase discounts and freight in and all of those things go straight to inventory. And under a periodic system where we're going to record them as discounts, purchase discounts, and purchase allowances, so that we can calculate the cost of our inventory at the end of the period. That's probably the most helpful way to think about that concept. Know what credit terms are and how they work for both the buyer and the seller. So remember that terms are usually written something like 1/10 net 30, which would mean a 1% discount if you pay within 10 days, and the net or the total amount is due within 30, or 2/10 net 30, or sometimes just net 30, meaning there's no discounts, but you have to pay within 10 days, or I mean 30 days. And then recognize that if I'm a seller, if I'm a buyer and I'm getting a discount, that usually what we will do is we'll go ahead and record that discount with a journal entry, right? So when I purchase something and I don't pay for it right away, I will put my asset inventory going up and my liability account payable also going up. If I pay full price for that, then I will just do an entry for the payment, which shows a debit to the account payable and a credit to cash. So my cash is going down to pay my account payable. If I take a discount though, then what I will do is I will debit the account payable by its full amount, and then there'll be some amount of discount that will reduce the amount of the account payable. So I debit the account payable by its full amount, and then the discount is credited and my cash is credited, and those two will add up to the full amount of the account payable, the debit to account payable. I guess that's the best way to describe it. Let's see. Be able to calculate cost of goods purchased and the cost of goods sold under the periodic inventory system. So again, our cost of goods purchased is just what it sounds like. It's whatever our purchases are, that's less any returns and allowances or things like that. That's going to be our cost of goods purchased. And our cost of goods sold is going to be our beginning inventory plus our purchases. That'll be what's called the cost of goods available for sale, minus the ending inventory, and that difference will be our cost of goods sold. Know how to calculate gross profit, net sales, net income. Recognize that net sales is just the sales less any sales returns and allowances, things like that. Gross profit is net sales minus cost of goods sold, and net income is gross profit minus any other expenses. Know the difference in content between a single step and a multi-step income statement. So again, let me pause this and bring up a picture of the two to help make that clear. All right, here you see that we have a single step income statement, which is just revenue minus expenses is net income. in essence. And then the multi-step statement, which has the net sales minus cost of goods sold is gross profit. Then all of these different expenses, operating expenses and so forth. So gross profit minus all of those is our income from operations. Then other expenses, and then it'll give us an income before income taxes, and then income tax expenses, and then the net income. So actually, you'll see the net income is the same under both. It's just that the multi-step statement has much more detail listed out, and that's the difference between the two. All right, so now we will take a look at chapter 6. All right, guys, you don't know it, but I've been away from my computer for several hours, just with family for dinner and stuff like that. But it feels like it's just been a moment to you. It's like suspended animation. Anyway, so we're gonna start in on chapter 6. So the first one is know how FOB shipping point, so freight on board shipping point and freight on board destination affect the inventory of the buyer and of the seller if the goods are in transit at the end of the year. So here you're just supposed to recognize that FOB shipping point means that the goods leave the seller's inventory and become part of the buyer's inventory as soon as they're loaded on the truck at the shipping point, so at the seller's location, as opposed to FOB destination, where the goods remain part of the seller's inventory for the whole time they're in shipment until they get to the buyer, at which point then they transfer over to the buyer's inventory and leave the seller's inventory. So you probably remember some of those from the homework, and so you'll just have to be able to do that. It's going to give you a scenario, and you got to figure out what the inventory is at that moment. Understand and know the difference between first in, first out, last in, first out, and weighted average inventory methods. Know which financial statement, cost of goods sold on the income statement or ending inventory on the balance sheet. The oldest and newest cost will appear under first in, first out, last in, first out. I think that's confusing. So you just have to know that under first in, first out, the oldest inventory items are the first ones sold. So if a company uses first in, first out, then their cost of goods sold is going to be based on their oldest items, and their ending inventory is going to be based on their most recently purchased items. Under last in, first out, the newest items are the first ones sold, which means that your cost of goods sold will be based on your newest or most recently purchased items, and your ending inventory will be based on the oldest items. And then weighted average is an average. So it's going to be somewhere in the middle, an average. Know how to compute cost of goods sold under all three methods. Use in a periodic system, and first in, first out, and last in, first out on a perpetual system. So you'll have to know how to do that. I can't explain it more. You'll just have to practice some of those. Understand that first in, first out, and last in, first out are cost flow assumptions on paper and do not have to match the actual physical movement of goods. In other words, these are assumptions. Some companies might sell some of their newer stuff first, older stuff. In fact, the whole point of this is sometimes it's really hard to tell if you're selling the newer stuff or the older stuff. So instead what you do is you use one of these assumptions to estimate what your cost of goods sold and ending inventory are. Understand and be able to compute the effects of an error that an error in ending inventory would have on the income statement and the balance sheet. So again, less than explanation, these are telling you probably some things to practice. And then understand and be able to compute the effects an error in beginning inventory would have on the income statement and the balance sheet. So again, I don't know what else to explain more about that other than you'll have to be able to do that. Anyway, and then know which methods give the most and least net income in inflationary and deflationary periods. So again, recognizing mostly what you have to recognize is that, depending on the method, And depending on whether prices are going up or going down, that's going to change your cost of goods sold. And the higher your cost of goods sold, the lower your net income. And so that's what they're asking you to be able to do, is recognize that whatever method is going to give you a higher cost of goods sold is going to give you a lower net income, and whatever method is going to give you a lower cost of goods sold is going to give you a higher net income. All right, so let's take a look at chapter 7. Let's see. So understand the objectives of having a system of internal controls. I'm sure there's some stuff in the book. Mostly you want to have internal controls to make sure that you do the things you plan to do, and to make sure that your employees aren't stealing from you. We can probably turn to the textbook, and that will give us a little more specific answer, or at least what the textbook publisher is looking for. So let me pause this a second and we'll pull up the textbook. All right, so here's what it says in the book. It says, it's a process designed to provide reasonable assurance regarding the achievement of company objectives related to operations, reporting, and compliance. In more detail, the purpose of internal control is to safeguard assets, enhance the reliability of accounting records, increase efficiency of operations, and ensure compliance with laws and regulations. So there's the textbook answer. I like mine better, which was like, make sure you do the stuff you're supposed to do and people don't steal from you. But same thing, right? All right. Next is know examples of specific controls that fit into each of the 6 principles of internal control. So this is a lot of book type stuff. Be able to identify which specific control might be violated in a given scenario. So it's going to give you these 6 principles of internal control. Here they are. And then you'll notice under each one, there's some things discussed. Rather than me reading that to you, I would just tell you that's what you need to do. And then this section where we talk about segregation of duties and so forth. So each of these 6 principles of internal control, you need to know those and be prepared to, what does it say? Identify specific control might be violated in a given scenario. Understand what controls a company should have specifically as it relates to cash. So again, you know, this is kind of book learning stuff. So cash handling, let's see what I'm trying to see what they're actually talking about. Well, I always struggle with these because I feel like the book wants something really specific. But, you know, there's the common sense side, which in real life works, but sometimes in the Wiley test doesn't. So here's the cash receipt controls. Again, recognize what those are. And then there's going to be cash disbursement controls. Again, most of these are common sense, and most of them, if you go work somewhere, they're going to have their own sort of processes that will line up with these controls. So again, rather than me reading them to you, I'm just showing you where they are in the book, because this is like textbook stuff more than it's problems right now. All right, so here's the big problem for chapter 7 is know how to prepare bank reconciliations, know what things go in the bank section and what things go in the depositor section, and whether or not the items would be added or subtracted. In other words, you have to be able to do a bank reconciliation. Remember, when you do a bank reconciliation, you start with the bank's balance, then you add any deposits in transit and subtract out any checks that have not been cleared yet, so uncleared checks. And then you would make any other adjustments for like an error or something. And then you get your adjusted bank balance. Then you would go to your book balance, or the balance you have in your books or records, and you would add in any cash receipts that were listed on the bank statement and subtract any cash payments. And then again, make any adjustments if there were errors to your book. And then that would be your adjusted book balance, and the two should match. And then recognize that any adjustments you make to the book, you'll have to make a journal entry for. Let's see. So that was prepare bank rec. Know which terms on a reconciliation need to be journalized by the depositor. Be able to make the appropriate journal entries. So like I said, any adjustments that you make to the bank balance So what that means is stuff that shows up on your bank statement that you didn't have recorded on your book yet. That would be like if the bank collected money for you, or if you found out a check had bounced, something like that, you'll have to do a journal entry for. Understand the basic principles of cash management. Again, this is stuff where the book wants you to sort of specifically know these things. This is actually what I just went over in learning objective 2 here, cash management. And then, let's see, be able to prepare a cash budget when a company has to maintain a minimum cash balance. So again, I don't know what more to tell you about that other than recognize that most of these problems involve making a budget, and then if you go over budget, having to borrow money on like an account payable to bring your cash up to a certain amount. You probably remember them from the homework. Anyway, so that's chapter 7. I feel like the limitations of this sort of a review is that I can just sort of go over the concepts with you. You still have to do the studying. I don't think I can quite spell, it'd be cool if I could just list everything to the point where this would be your study just to listen to this. But my hope is that you'll go through this and you'll sort of write down notes of, yeah, I understand this, or no, this is something I need to look at more. All right, so let's take a look at chapter 8. So the first thing in chapter 8 is know what kinds of receivables comprise trade receivables. So all a trade receivable means is a receivable that arises from a trade transaction. So as opposed to borrowing, in case of receivables, instead, as opposed to lending money to somebody, which would create a note receivable, any receivable that, like an account receivable that arises from me lending, or giving somebody goods or services and then allowing them to pay me later, or a note receivable that we write specifically because I'm selling them something and they promise to pay me later. Those would be trade receivables. So it's just any receivable that arises from trade, from selling something to somebody. The second one is know when to record receivables on the company's book, and that's pretty straightforward. It's when if I perform a service for you and you don't pay me, then you're not going to pay me until later. Then I go ahead and record the revenue because I've earned it. That's my credit, and then my account receivable would be my debit. If I'm selling goods to you, it's at the time I transfer the goods to you. Again, I would record the sales revenue and the account receivable. And if it's something like a note receivable, then when we agree upon the note, that will be the start date, then we would record the receivable. So that's pretty straightforward. Be able to calculate the actual cash received when collecting on an accounts receivable when returns and allowances and discounts are involved. So if you remember these from the homework, this is where you sell something to somebody and then they owe you, and then they return a portion of it, or you give them a credit, an allowance for it, and so that reduces the amount they owe you, and then they pay it within the discount period, so you have to take a 3% discount off of that. And so really the trick to those is just recognizing first the amount of discount or credit, not credit, of the amount of discount that you're going to give the person, and then calculating how much they still owe you, and then calculating, I'm sorry, I'm using the wrong words, the amount of allowance that you're going to give them in return you're going to give them, and then subtracting that out from what they owe you, so you know the actual amount they owe you, and then applying whatever discount they get to that. So again, hopefully you remember those from the homework. Be able to make the journal entry that a firm would make when collecting on the maturity date of a note, assuming the interest has already been accrued in a prior period through an adjusting entry. So this is one that a lot of people miss. And I think they miss it just because they forget about adjusting entries way back in chapters 3 and 4, where we sort of learn about that. You forget that when you get to the end of the accounting period, you do this adjustment to show the interest payable, or the interest receivable, depending on the situation. So for example, if I loan money to somebody and they're going to pay me a certain amount of interest, so let me just do an example here. So let's say I loan money to someone, an 18-month note, and they're just going to pay me all the interest back at maturity. And I loan them $100,000, just to make our math easy. And it's a 6% note. Okay. So let's say I make this loan on March 1st of 2019. So what's going to happen is this person doesn't have to pay me until the note comes due in September of 2020. But they are going to have to do an adjusting, I'm going to have to do an adjusting entry to show that I've earned some of this interest revenue during 2019. So when I first write the note to them, my journal entry will look like this. It'll go notes receivable, $100,000, and then my cash will go down by 100,000, right? Because I'm loaning out cash. So that's going to be the entry I make on March 1st, 2019. Then at the end of the year, so December 31st, 2019, I'm going to have to do an adjusting entry to recognize that I have earned some interest revenue during the year. And so that's going to be a debit to interest receivable, if I can type it, and a credit and a credit to interest revenue. The amount is going to be the principal times the rate times the time, which is the principal, which is $100,000, times the rate, which is 6%, times the time, which in this case is from March to December. So March, April, May, June, July, August, September, October, November, 9 months. So I want to just put 9 divided by 12. So that is my adjusting entry on December 31st. So now when the note comes due on, what was it, September, is that what we decided? March to March is 12 months, April, May, June, July, August. So September 30th. Now I have to do this journal entry, and this is what they're saying you have to be able to figure out. You have to figure out what the total journal entry will be. So remember, you're going to get paid some cash. You're also going to get rid of that interest receivable account because they're not going to owe you anymore. Whoops. And you're also going to have to recognize the interest revenue that you've earned for 2020. Sorry, this isn't September 30th, 2019. This is September 30th, 2020. And then finally, we're going to have our notes receivable go down. Okay, so the notes receivable is going to go down by the full $100,000. And the interest receivable, which has a debit balance of $4,500, is going to go down or be credited $4,500. And then our interest revenue is going to be any interest we've earned during 2020, which is January through September 30th, which is 9 months. So we would say the principal, 100,000, times the rate, 0.06, times the time, which is 9/12. So another $4,500, right? And then the amount of the cash we're going to receive is the full $109,000. So what they're saying is you have to know how, given this information, to calculate or to do this journal entry right here. So you have to know what journal entries happened before. And I think that's what's really hard for people is recognizing, oh wait, at December 31st of 2019, they would have had to accrue that interest revenue. And now when they receive payment, they're going to have to get payment for the amount accrued at the end of 2019, plus the amount of interest revenue that was accrued during 2020 from January 1st to September 30th, and then plus the note receivable. And that's the total amount of cash. So that's going to be a tough one that I think a lot of people will miss unless they practice it. All right, so the next one is to know what the face value of the note represents. So the face value of the note, that's this amount, the amount that you actually lent. So and the amount that has to be paid back at maturity plus interest. So the face value, and it's the amount that the interest is calculated on. So on our $100,000 note, we would say the face value is $100,000. Know how to compute and accrue interest revenue on a note receivable, including the appropriate adjusting journal entry. So I just went through that process. And then be able to use simple interest equation to calculate the principal on a note if we know the interest amount and the rate and the time period in days. So we know that it's principal times rate times time equals interest. So if we know the interest and the rate and the time, then we know that we could calculate the principal if we had to. Also, recognize that there was some confusion earlier in the course about should we use a 360-day convention if we're doing daily interest or a 365-day, and use a 365-day convention. Okay, 365 days in a year. If the system marks you wrong, I will give you credit back on it. All right, so that does it for chapter 8. So now let's take a look at chapter 9. Sorry, I'm having a hard time. I have my Zoom controls were blocking me being able to close out or minimize my Excel spreadsheet here. All right, chapter 9. All right, know how to compute the cost of various types of plant assets, land, building equipment, and land improvements. So recognize that when we're buying that asset, any cost of putting it into service is part of the cost of it. So if we buy equipment and we have to have it installed, then that's all part of it. If we buy a big piece of equipment and have to pay to have it moved, that's it. That's part of it. If we have to pay insurance on it when it's being shipped, that's all part of the cost. Also recognize that land improvements are tracked separately from the land. So things like pavement or asphalt on a parking lot or fencing or curbing, those things are going to be tracked separately from the land because we don't depreciate land. And so, but we do depreciate land improvements. Why? Because asphalt parking lots will have to be replaced at some point, whereas the land is considered to sort of hold its value over time. Know what the book value is and how it's calculated. So recognize that the book value of an asset is its cost less any accumulated depreciation. And that's how we calculate it. If we're, and if we, depending on the type of depreciation we're doing, that'll change, right? We will calculate straight line just by dividing the total amount by the total cost less the salvage value by the useful life. And then if we were to use units of production, then we would, instead of dividing it by its useful life in years, we divide it by useful life in units. And if we were doing a double declining balance, then we'd have to go through that process of figuring out what the balance is, multiplying that by our depreciation rate, which is which is 2 times what the rate would be as a straight line, and so forth. So know what the term depreciation means. Recognize that it is not a loss of value. People always think of it that way, but it is instead an allocation of the cost of something um, to an expense spread out over the life of an asset. So the idea is that it's the matching principle, right? If I buy a car and I'm going to use it for 5 years, then if I take the total cost of the car as an expense now, but then continue to earn revenue on it over the next 5 years, that really throws things off. So instead, what I'll do is I'll take the value of the car, I'll spread it out over the 5 years, and take the expense spread out over that 5 years, so that the expense will match up with my revenues over that period. So know how to compute depreciation using the straight line method for both full and partial years, okay? And be able to calculate accumulated depreciation balance after 2 years of recording depreciation. Make sure when you're doing this that you're careful to recognize how many years. Sometimes people just misread it and they'll only do like 1 year's worth. So just recognize what you'll have to, how many years you're depreciating for. And recognize that sometimes you depreciate for partial years. If you purchase something in March, you don't take a full year's worth of depreciation in December. Instead, you take, well, it depends on when in March. If you do it at the beginning of March, then you would take 10 months worth of depreciation at the end of the year. Let's see, be able to calculate the gain and loss on the sale of a fixed asset. Remember that depreciation must always be brought up to the date of the sale prior to actually calculating the gain or loss on the sale. So that's an important point. So when I sell an asset, I'll have accumulated depreciation up until December 31st of the year previous. So before I record that sale, I'll have to record the depreciation on the asset from January 1st until the date of the sale. And then my accumulated depreciation account will be correct up to the moment of the sale. And then I'll take my cost less the accumulated depreciation, and that will give me my book value. And if I sell it for more than that book value, then I've made a gain on the sale. If I sell it for less than the book value, then I've had a loss on the sale. And if I sell it for exactly the book value, then I've had neither a gain or a loss. So be able to calculate that. Know which accounts are considered to be intangible assets, including what costs are included in each. So let's take a look at the textbook to get I guess, a clearer idea, because I would say typically when I'm talking about intangibles, I'm talking about things like copyrights, patents, and a few other things. So I want to let's get a good list out of the book to make sure it's clear. All right, here we are in the book. So there are types of intangible assets, patents, which would be the cost of either getting the patent or, like all the research and everything that went into getting the patent. Well, not the research as much as what was either paid to acquire it, or either by filing all the legal stuff or by purchasing it from someone else, because that's separate from research and development, or R&D costs, which are the costs of researching and developing something. Copyrights, again, those costs will be, and then trademarks and trade names. So that's what they're listing in the book as intangibles, I think. Oh, no, they're doing a couple others: franchise rights, goodwill, and so forth. So just, you might want to read through that section because it's not enough apparently just to know what they are. It says including what costs are included in each. It says including in each, but I think they mean included in each. Know how to deal with the cost of successfully defending a patent. So again, that's where they're giving you like maybe a very specific question that deals with patents. Recognize that if somebody challenges your patent and you have to go to court, then the cost of defending that patent. Let's see. I'm turning right here in the book. Also recognize though that, like, I realize they want you to learn this, but like in real life, like patents are a pretty specialized piece of accounting and a pretty specialized piece of law as far as, you know, a lot of you will go into business and never have to deal with that. Um, so I'm not sure why they're so hot on us knowing these things about patents. Um, so recognize that, let's see, if an owner incurs legal costs in successfully defending a patent in an infringement suit, such costs are considered necessary to establish the validity of the patent. Thus, the owner adds those costs to the patent account and amortizes them with the remaining over the remaining life of the patent. So, if you have to go and defend your patent in court, then what you're going to do is add those to the cost of the patent and then recalculate your amortization from that point on. Um, Again, not sure why that should make the exam, but I didn't create it. So let's see, be able to compute the amortization of an intangible asset. Remember that it may be for only a partial year, just like depreciation. So almost always assets are amortized in a straight line, and you do it just like depreciation. Um, and so if you can do depreciation, you can do that. And then know how to account for research and development costs. Again, those are handled right here. Um, and just recognize that. So um, you know, as a company does R&D, then they tend to record those costs as an expense as they incur it, and then when they, you know, when I don't know what else to tell you. So recognize that. Again, not sure why we're spending so much time and effort on those 3 points, but um, we are. So there it is. So that's the end of chapter 9. Now let's take a look at chapter 10. So the first one is understand the difference between a current liability and a long-term liability and examples of each. So I think you guys know that pretty well, but a current liability is a liability that is going to come due within the next year. And a long-term liability is a liability that is due in more than a year. So the most common examples of current liabilities would be things like accounts payable, which is usually due within the next 30 days or so, or you know, a short-term note payable of some sort. And then recognize also that some long-term liabilities, like mortgages, usually have a portion that is current, and then a portion that is long-term. Know how to report the current portion of long-term debt on the balance sheet. So if you'll remember these, the balance sheet has current liabilities and long-term liabilities, and under the current liabilities, you'll just list current portion of long-term debt or something along those lines. Know how to journalize the entries when a note payable is issued and when a note matures. So when we issue a note payable, it's, or what, actually not when we issue, uh, when we borrow money. Okay, so it's our note payable. It's going to look something like this. Our cash will go up, and our note payable will go up. Right, it's a liability, so it goes up with a credit. So if we borrow $10,000, whoops, that's reading me as a percent right there. Okay. It doesn't want me to change it for some reason. Let's enter. All right. We'll just tell this it's funny too. All right. So that's what happens when I borrow money. Okay, cash gets debited, my cash increases, and my note payable increases. And then it says note payable is issued, and when the note matures and is paid, either if interest has or has not been previously accrued previously. So if it has not been accrued previously, then when I pay it, it's going to be something as simple as note payable, interest expense, and then cash. where the note payable will be the face value of the note. What in the world? The interest expense will be whatever interest we accrued on the note during its lifetime. So let's just say $2,000. Okay. And then our cash will be $12,000 going down, right? So we're just paying it. So that's what would happen if we borrowed the money and paid it back in the same year. Whereas if we borrowed it and then paid it back in a year later, or in a new year, a new financial period, we'd have to account for the fact that some portion of the interest expense was incurred in the previous year and some portion of it is incurred in this year. So again, there would be some sort of adjusting entry at December 31st to show that the interest had accrued in the previous year. And then when we actually paid it off, we'd have to take care of that by dealing with the interest payable that happened during the adjusting entry. And then any interest expense that occurred during the current year, and then cash. So I'm skipping the adjusting entry to showing you what you would do at maturity if there had been an adjusting entry. Like that. All right, let's see. Know how to calculate sales tax when it has not been rung up separately from sales, and be able to make the journal entry to record sales and sales tax. So again, you'll see some problem that's something like, you know, so-and-so made a sale of $827 with 6% sales tax included. And so you have to figure out how much of that is sales tax. So if you recognize how, that to figure out, so if let's just say, so our total amount is $827. And we know that tax was 6%. Okay. And so we're supposed to figure out, well, then how much of that $827 was tax, and how much of that $827 was the money that's ours for the goods we sold. So recognize that the formula would look like this. The cost of the goods we sold times 6% would be the amount of tax. Okay. Another way of putting it is the amount of the goods we sold times 1.06 would be $827, or the total amount. So if we just divide that, let's see. That's going to tell us how much of that was the sales price of the goods that we sold. And then the amount of the tax is just going to be the total amount minus what was the sales price of the goods. So you have to know how to do that. And you have to know how to do the journal entry, which would be something like, my cash goes up $827, and my sales revenue goes up by $780.19. Whoops. And my sales tax payable goes up by $46.81. There's my journal entry. All right, let's see. Know how to compute and record payroll entries and payroll tax entries. I'd say the biggest thing to remember there is that there are the payroll taxes that the employee is responsible for. Then there's payroll taxes that are a cost or an expense to the employer. And then there's payroll taxes that are split, that the employer has to pay half and the employee has to pay half. And in order to successfully compute that, you have to know the difference, right? That Social Security and Medicare are split. Each the employer and the employee each pay half of that. But usually there's a state and a federal unemployment that are the responsibility of the employer. And then things like withholdings, well, first like federal income tax and state income tax, and then withholdings like for insurance and stuff, those are the responsibility of the employee. So you have to kind of make sure you're aware of that. They might even throw a curveball at you and say the employer pays for insurance for the person. You just have to pay attention and be careful to recognize what portion of it is the employees, what portion is the employers, and then what portion might be shared between them. The other thing you have to be careful of is things like Social Security and Medicare. They have caps. What I mean by that is, Social Security tax is only paid on the first $109,000 of earnings. So if somebody earns $120,000, they'll only pay $109,000 times the rate. Things like that. Again, those usually always in the details of the problem. You just have to read the problem very carefully. Let's see. Know how to journalize unearned revenue. Remember, unearned revenue is when you receive money before you've earned the revenue. So when that happens, you show your cash going up and your unearned revenue account, if I could type, also going up. Unearned revenue is a liability, okay? So if somebody pays me $10,000 in advance, here's gonna be the journal entry. Then as I earn the revenue, so let's say at the end of the month, I've done half of the work I was gonna do for them, I'm gonna show my unearned revenue going down. Since the liability, it'll go down with a debit. And then my service revenue account, or whatever type of revenue it is, going up. Okay, so that's how you journalize unearned revenue. Let's see. Oh, I think I skipped know how to compute. No, we did payroll tax. Know the following: the difference between a convertible bond, a callable bond, a secured bond, and an unsecured bond. So a convertible bond is a bond that can be converted to stock under certain circumstances. A callable bond is a bond where the borrower, so the issuer of the bond, reserves the right to pay the bond off early. Okay. A secured bond is a bond that is secured by an asset, much like a mortgage is secured by, like the home, or auto loan is secured by the car. Secured bond is secured by some asset, as opposed to an unsecured bond, which is not secured by an asset, and so it's only secured by the faith and credit of the borrower. I'm sorry, so if you purchase an unsecured bond, then you're depending on the borrower to pay you back, and don't have any assets underlying that to protect you. All right, be able to make the journal entry for the acquisition of a building by the issue of a mortgage note payable. Okay, so again, these will either come in one of a couple flavors. One is that they pay for the whole building, so our asset building will go up and mortgage payable will go up, like that. Often you'll have a down payment, so they'll pay a portion of it in cash. So then you'd say the building goes up, cash goes down, and the mortgage payable is the difference, right? The amount that you borrowed, like that. Understand the effect when the stated interest rate differs from the market interest rate on bonds payable in relation to having premiums and discounts. So all you really have to know is that there's an inverse relationship between the bond price and it's what it will be issued at and the market interest rate. So if market interest rates go down, then bond prices will go up. And when a bond is issued above its par price, so above its face value, then that bond is said to be issued at a premium. So recognize when market interest rates go down, then the bond prices go up and are issued at a premium. And when market interest rates go up, then bond prices go down and they're said to be issued at a discount. Be able to calculate the long-term liabilities of a company. Hint, you need to know how the premiums and discounts on bond payable figure into this calculation. In other words, in the long-term liability section, they will have something like a note payable. They may have a mortgage payable and tell you a certain part of it is, or not even tell you, you'll just have to calculate that a certain part of it is current, so that only part of it is long-term. And then they'll have bonds payable and show that there'll be discounts. And so you have to know that you'll subtract out the discount on bond payable to find the balance of your, we'll call it the book value of your bonds payable. So you need to know all those things to be able to figure that out. Finally, be able to compute the interest and the principal portion of a payment on a mortgage installment loan. Determine the balance of principal after a specified number of payments. Again, it says read the dates carefully. You've probably figured out over the last few months that accounting, at least a big part of it, is being careful, is recognizing that there's a lot of information coming at you and you have to read it carefully. So again, recognize that an installment loan has a fixed payment. And so the amount of that payment that is interest and the amount of it that is reducing principal is going to fluctuate after each payment. So for example, if I had an installment loan, let's say I borrowed $100,000 and it was a 6% loan, I would know that, and let's just say it had to make annual installment payments. So of $10,000. Okay, so my interest in the first year, at the end of the first year, would be the rate, principal times rate times time, right? And since it's 1 year, you say principal times rate times the time of one. My interest is 6,000. So my principal payment. Whoops, I'm typing that in the wrong place. My principal payment is just the payment of 10,000 minus the interest payment. And so my new balance on my loan then is going to equal the amount of the loan at the beginning of the year minus any principal payment at the end. And so now I'll carry that forward to the next year. And to find out the amount of interest, I will take the principal of the loan for that year times the rate. And then the amount of the principal payment is going to be the amount of the payment, $10,000, because that's the same every year, minus the amount of interest. And then the new balance of the loan is going to be what it was at the beginning of the year, minus any principal I paid during the year, and so forth. And so over time, the amount of my payment that is interest will go down because interest is based on the principal value. And the amount of my payment that is principal will go up until in the end I'll have paid off the entire note. So that is the end of chapter 10. Let's move on to chapter 11, the last chapter to talk about. I know that will be exciting. All right, so in chapter 11, again, we have some stuff that I would call textbook stuff and some stuff that is more like a problem you have to work out. Good news is for chapter 11, you don't have to know any ratios, so there won't be any ratio questions on the final exam. I guess the people who made the test just decided that that would be too mean to make you memorize all of that. So the first thing they want you to do is know the characteristics of the corporate form of organization. So again, that's kind of a book thing. I'm going to pause this for a second and turn to that page in the book. All right, so here's our characteristics of a corporate form. First is that it's separate legal existence, meaning corporation is like a separate entity, almost like a separate person legally. The second is that it has limited liability to stockholders, which means that the stockholders, if the corporation gets sued, their liability is limited only to the amount of their capital in the business. And then transferability of ownership rights. That means I can sell my shares of ownership in the corporation and don't even have to get permission of the other shareholders typically. The ability to acquire capital. So corporations can borrow money or issue stock to acquire capital. And that has continuous life, which means that the corporation, even if one of the owners dies, the corporation will continue to operate. And then it has corporate management, which means even though the stockholders own the company, their management is sort of limited to being able to elect the chairman and board of directors. And then the board of directors and chairman, they manage or run the company. And if the stockholders don't like the way they're running it, then they can't go in there and run it for them. Instead, the best they can do is fire the chairman and hire and board of directors and hire new people. So that's the characteristics of a corporation. Let's see. So recognize that the par value of a stock is this strange kind of antiquated system where some states still require companies to declare a par value. It used to be based on the amount of capital that the business had to have in it, but a lot of states don't require that capital anymore. So now the par value just is a stated amount of money that a share is worth, and that makes it complicated for the accountants because the accountants have to track the par value of the stock plus any capital that was contributed in excess of the par value. Be able to make journal entries for issuing shares of stock and for cash at a stated value or par value and at a price above the stated par value. So just recognize, I think we just did this chapter, so this is probably less hard for a lot of you, but recognize that if we issue stock at its par value, so let's say we issue 10,000 shares at $1 par value, then our cash will go up by $10,000. And our common stock account will go up by 10,000, just like that, easy. But if we issue 10,000 shares of $1 par stock or $1 stated value stock for $2, then our cash will go up by 20,000. Our common stock's still only going to go up by 10,000 because we always record it at the par value. And so any amount over and above that that we raised for issuing the stock is going to have to be recorded as something like paid in capital in excess of par, or something like that. You'll see a few different wordings depending on who you're working with. All right, be able to calculate the number of shares of common stock outstanding. So this one they've had in a couple of problems that you've just worked out recently, and people get a little confused by it. Recognize that common stock outstanding would be any issued stock minus any treasury stock. So to figure out how much stock is issued, what you're going to do is you're going to take the dollar value of the common stock on the balance sheet and divide that by the par value per share, and that will give you a number of shares of common stock outstanding. I'm sorry, issued. And then you would subtract any issues of treasury stock or any shares of treasury stock to find the number of common shares outstanding. Know what effect the purchase of treasury stock would have on the stockholders' equity on the balance sheet. So when the company purchases treasury stock, so that is issued and outstanding stock that the company then buys back into their company. And that's called treasury stock. And what we do is we subtract the value or the cost of that treasury stock off of our stockholders' equity and the balance sheet. Be able to make the journal entry when a corporation purchases its own shares of common stock into treasury stock. The journal entry is actually super easy because it goes at the cost. So If I purchase 1,000 shares of my company for $65 per share back into treasury stock, I'm just going to put treasury stock, 1,000 shares times $65 a piece is $65,000, and the cash goes down. That's the journal entry. That's pretty easy. And again, that will show up as treasury stock on the balance sheet at the cost of $65,000, regardless of what the par value of the stock is. Know about the basic rights that accompany both preferred and common stock ownership in a corporation. So again, we're going to turn to the book because I think this is another one of those things that is kind of a textbooky question. And I want to make sure I tell you the way the book has it. So let's see. Those are the advantages and disadvantages. So here's our stockholder rights. Probably the next page. All right. So stockholders get to vote for the board. So they get a say in the board of directors. They get a share of earnings through dividends. They get to keep the same percent of ownership even when new shares of stock are issued. So that's called preemptive right. So if they issue new shares of stock, they've got to give some to me so that I still, if I had 14% before, I'll have 14% after. And then if the company goes out of business, then I have a share of anything that's left over after we've paid off our creditors. Think about that. If an owner of a business sells off the business, the first thing they have to do is pay their debts, and then whatever's left over gets divided up among the owners. So that's my rights as a common or as a stockholder. Okay. Let's see. Be able to make an entry for the issuing of stock for assets and services other than cash, such as acquiring land by issuing stock. So again, that's pretty straightforward. The transaction would look something like the asset, let's say land, goes up by its fair market value. I think that confuses people sometimes. Let's say the fair market value is $50,000. And then the stock, so depending on the number of shares of stock I issue, let's say I give them 1,000 shares of stock that has $1. I'm sorry, I give them 10,000 shares of stock that has $1 of par value. So I would enter this as common stock of $10,000 and then paid in capital in excess of par of $40,000. So the trick to these kind of entries is you have to use the fair value of the land or of the asset that you're acquiring. Then you record the common stock at its par value for the number of shares that you're issuing for the asset. And then any difference in between what the fair value of the asset was and the par value of the common stock is going to be considered paid in capital in excess of par value. Let's see. Know what effect cash dividends declared ultimately have on assets, liabilities, retained earnings, and the total stockholders' equity of a company. So this is a pretty interesting thing to look at. So when we issue a cash dividend, so when we declare a cash dividend, the first thing that happens is I'll call it cash dividend. Let's say they declare a cash dividend of $100,000. So the entry will look like this. Then on the date of record, nothing will happen. There'll be no journal entry. Then on the payout date, when we actually are going to pay that out, the journal entry will look like this. So an important thing to recognize is that when they declare the dividend, it's recorded as a cash dividend on the declaration date. Sometimes people get confused by that. then what will happen is at the end of the year, there'll be a closing entry, right? And that closing entry will be to get rid of that cash dividend of 100,000. So we'll do retained earnings. Remember, a debit to retained earnings is a reduction of retained earnings. And then the cash dividend account goes down by 100,000, back to zero really, because it's a closing entry. So recognize that what happens is when we declare it, we create a liability and a dividend. Then when we pay it, we get rid of the liability and our cash goes down. And then when we close it out, our retained earnings goes down. So ultimately what happens is we pay out $100,000 in cash, and that money comes from retained earnings. So that's the whole process right there. Know what effect cash dividends and stock splits have on the retained earnings and on the overall stockholders' equity of the company. I'm trying to remember, there's a really great little comparison that shows that in a way that is probably easier than me trying to explain it. So give me a second. I'm gonna, well, you won't know. I'm pausing this, but it'll just seem like a brief moment, and I'll come back on with a good illustration for you. All right, so here's an example of what happens when we do a stock dividend. So before the dividend, there's a certain value of our common stock and a certain amount of retained earnings, and our total stockholders' equity is going to be the amount of our stock plus our retained earnings. So when we do a stock dividend, in this case, it looks like they're doing a 10% stock dividend. So they're going to go from 50,000 shares to they're going to add 10% or 5,000 more shares. And the par value of that stock's going to go up by 10%, so another $50,000. But then it tells us the market price is $15 per share. So we have to do some, so it's going to be the first $10 is going to go toward the common stock account. And then the other $5 per share is going to go to the paid in capital in excess of par. So their total paid in capital is going to increase by $75,000. We have to pay for this from somewhere, and that's from retained earnings. So retained earnings is going to go down by 75,000. So after the stock dividend, we'll now go, we'll go and from 500,000 shares before to, I'm sorry, $500,000 worth of common stock to 550,000 common stock plus an additional 25,000 in paid in capital in excess of par, for a total of 575,000. Our retained earnings will go down by 75,000, which means our total stockholders' equity will be unchanged. Okay, recognize that our stockholders, our paid in capital is increasing while our retained earnings is decreasing. In other words, we're giving shares of stock to the current owners as a dividend, and we're paying for it out of retained earnings. So that's what happens with a stock dividend. By contrast, when we do a stock split, so here is an illustration of what happens when we have a stock split. We have $500,000 worth of common stock out there, and we have $300,000 in retained earnings, so a total of $800,000, and we have 50,000 shares, so our par value per share is $10. When we do a stock split, this is a 2-for-1 stock split. The value of the stock doesn't change at all. We still have $500,000 worth of stock, still have $300,000 in retained earnings, so $800,000 total stockholders' equity. But now we have 100,000 outstanding shares, and the par value per share is $5. So all a stock split does is it doubles the amount of outstanding shares and cuts in half the par value per share. So that's the difference between the two. Let's see. So again, know what effects stock splits and stock dividends have on retained earnings. Stock splits have no effect on retained earnings, whereas stock dividends reduce the retained earnings by the amount that the stock goes up. So we're paying for the new shares of stock that have been issued out of retained earnings. Be able to calculate the amount of dividends that would go to both preferred and common stockholders for a series of years, assuming it is either cumulative or non-cumulative preferred stock. So what you have to recognize here is, first of all, companies figure out a certain amount of dividend they're going to pay. So a certain amount of cash that they're going to pay out as a dividend. That's the first thing that happens. Second, recognize that preferred shareholders are going to get their dividends first, and anything left over is going to go to the common stockholder. Third, recognize the difference between cumulative and non-cumulative preferred stock, and read carefully as you're reading through, because they'll try to trick you. Okay, so cumulative preferred stock means that if I hold that preferred stock and it doesn't pay dividends in 1 year, or it doesn't pay full dividends in 1 year, and then it pays dividends in the next year, I have rights to not only the dividends for the year when it's paying, but any dividends missed in previous years before the common shareholders get anything. Whereas if it's non-cumulative, then if the preferred stock doesn't pay dividends in a given year, I just don't get dividends that year, and I have no claim to them in the future. So in order to calculate this, you have to know all of those things, which is the amount of dividends, and then whether it's cumulative or non-cumulative preferred stock. So again, you just did this chapter, so this is probably a little bit easier, but you'll want to take a look at that again and make sure you're comfortable with it. Be able to calculate the total stockholders' equity. So total stockholders' equity is all of the contributed capital, which would be the common stock plus any additional paid-in capital on the common stock, the preferred stock plus any additional paid-in capital on preferred stock. So that's your total paid-in capital plus your retained earnings less your treasury stock. That's going to be your total stockholders' equity. Know what it means to have a restriction on retained earnings. So recognize that sometimes companies, sometimes it's a legal thing that they didn't choose. Other times that they choose it because they want to maintain a certain amount of money in the retained earnings account. It just means there's a certain amount in the retained earnings account that they're not going to go below for whatever purpose. So that's what a restriction on retained earnings is. And then be able to calculate the ending retained earnings for a company with cash dividends, stock dividends, net income, net loss. So recognize all the way back to the beginning of this class that our statement of retained earnings is our beginning retained earnings plus any net income, or minus any net loss, minus any dividends is our new retained earnings. And that's it. So hopefully this was useful to you, this sort of instead of a walkthrough, I'll call it a talk through of the review. And good luck on the exam. And then when you finish the exam, have a great break until the next semester starts.